The reason why the market paused or has not been as appreciating, if you will, is that we had the fastest 6-month rate increase in the history of lending. Interest rates went up 2.36% in 6 months. It's the fastest 6 months. So that's one thing that we're seeing, this abrupt uptick in rates. If you look at stock market, we're at a 6-week high, so we're only down about 14% versus like 22%. That's a pretty big comeback. We're seeing interest rates last week, per the mortgage data on a conforming loan, hit 7.16%, like per the industry. And that's a 20-year high. So rates have gone up like 10 straight weeks or something like that. And this data is all within the last week, so it's pretty current. Refinance applications from 1 year ago are down 81% as an industry. Purchase applications down 37%. We're seeing the 10-year treasury over 4%. As I've touched on before, that's really a key barometer for how mortgage rates are moving as well. When you see that 10-year treasury, rates usually follow that same trend. 7.16% on conforming loans. That was last week. On jumbo mortgages, the average rate 6.53. So that's a loan amount that exceeds the conforming limit. FHA mortgages at 6.79%. 15-year fixed conventional loans 6.39. For 5/1 ARMs last week as an industry, 5.86% as an interest rate. Wells Fargo does not allow rental income if someone's buying a home. So I just got a deal where a client was trying to go through Wells Fargo buying a rental, and they wouldn't give him any income on the rental, so he didn't qualify. So we got that loan done because we didn't have that restriction. I had a client, if anyone's working with foreign national clients, they're not from the U.S., they don't have a U.S. social, they don't have an I-10, that type of loan has been hit really hard. And so we're still doing those. We had a loan where a client was trying to do a loan through a hard money loan. He couldn't get it done. We were actually able to get him cash out and do his deal. So we're trying to expand guidelines and do more. So a client selling a home, she wanted to buy a home first because she found her dream home. We were able to take out cash on her current home and do a bridge loan where we did not have to hit her with that payment, give her up to 75% loan to value. We front load some cost up front so there's no risk of what's called an early payoff or an EPO. So we gave her a bridge to help her get into her new property. We exclude the current home, and she's buying this new property and essentially closing 2 deals at once. And then when she sells her home, she'll rebalance everything. But usage of bridge loans is really important because sometimes a client, they're not as strong when they're contingent. So we all know that. It's not as tough as it was 3, 6, 9 months ago, but it's still competitive. I know one of your advisors had, I think, 45 offers on a property a couple weeks ago. So usage of products is so important. A lot of you guys have heard me talk about the debt service coverage ratio loan, the DSCR. This program was extremely lenient the last year. It's now tightening up where in most situations, the property has to ratio on its own. What that means is that the rents have to cover the mortgage payment. So it's important to look at, does your client now qualify for that DSCR loan where 6 months ago it was super easy. There was no ratio requirements. It could be negative cash flow, but now it's getting tighter and tighter. And that's just the general right now, is everything is tightening up is what we're seeing. Programs are going away, banks are going away. We're seeing a lot of clients buy homes with cash and then take out cash immediately. It's called delayed financing. It was more popular last year. Certain lenders have put restrictions in where they have to have that homeowner on title to establish what's called continuity of obligations, but we don't have that. We can do immediate cash out. So if somebody has to pool money or essentially liquidate or however they get cash out, we can essentially backfill their accounts right away. So it's kind of a cool feature we have. We're doing a lot of no money down. These were not popular because it was impossible to get a deal accepted, but we're doing no money down loans. Down to a 620 FICO score on jumbo. A lot of people got hit hard. I think it's 18% of Americans have less than a 580 credit score. So COVID, inflation, other factors has really hurt people's credit. So we have kind of widened our credit box when others are sort of doing the opposite. And we're doing a lot of lines of credit. So the reason I mention lines of credit is I've seen clients take advantage of doing lines of credit and use that cash out to buy other property. I did it years ago in a house I had, so it really works. The reason we're doing more lines of credit versus first trust deed cash outs is nobody wants to touch their first mortgage, right? What is a line of credit? So a line of credit is a second trust deed. It falls behind your first loan. A general line of credit is a 25-year loan. first 10 years are interest only, and then it goes into the repayment period where it does a 15-year balloon payment and essentially amortizes over the remaining 15 years. It's pretty cool because you can use your house almost like an ATM. You essentially only make payments on what you draw. So if you take out a $300,000 line of credit, but you only need $50,000, etc., you're only making these small incremental interest-only payments. So it keeps your payment very low. People can pay off debt to build credit. They can buy cars, and of course, love to see them buy houses with each of you. So look at lines of credit. It's a great way to help these folks expand their real estate portfolio. A few more things. I did a SWOT analysis looking at 6 months back, current time, 6 months forward. You're hearing out there, should we buy? Should we buy? What should we do? 6 months ago, it was extremely nerve-wracking, emotional, stressful for clients. I wouldn't want to have to compete with 10 offers and try and go out and look and not find a home. 6 months forward, which I want to touch on in a second, rates are forecasted to drop. So you keep hearing, it's getting a little bit cliche, but you date the rate, you marry the mortgage, or you rent the rate, right? We see it on every meme from every Instagram post. But really, Fannie Mae is predicting. Fannie Mae is the largest secondary market investors of conforming loans, right? Multi-billion dollar company. They're forecasting rates being 4.4 to 4.7 next year on a 30-year fixed. The Mortgage Banking Association is forecasting a 5.4 rate. So you average those out, you're looking at roughly a 5% rate. That's a 2% drop. That's a pretty big difference. So this date the rate, marry the mortgage actually makes sense.